So our next panel is called Raising Capital in 2026, and these are going to be some straightforward questions. It's about what investors actually want to know. Today in front of us, we have Crossville Firm, which is one of the strategic partners with Tampa Bay Tech REIT. And the premise of our partnership is that we actually help the organizations. We kind of guide them through. We know some of the preliminary aspects of what Prosper is looking for. We intake companies, kind of review their information. If we feel they're worthy, pass them over to Prosper Firm. Prosper Firm serves as a broker, not just your typical brokerage show. This is a organization that actually looks through your business plan. They give back feedback. They let you know exactly what's working and what's not working. They give you the opportunity to actually find the funding you're looking for in multiple ways, VCs, SBA loan. I would say all the way from your traditional to non-traditional funding. And that's what we love about them. And we kept looking into the aspects of what was happening in our community. And as we kept full of data, the main thing we heard was there is no access to capital. So by a show of hands, who's actually trying to raise money right now for their organization or for their company? 1, 2, 3, 4, 5, 6. Out of the 6 people that are raising money, how many of you are pre-revenue? 3, 4, 5. 5 out of 6 are pre-revenue. I don't know if that's a starter point we want to have right now, but let's go back a little bit further. In the next 12 months, how many of you plan to be raising money for your organization or your company? Okay. I'm predicting at least 7 of these people will become clients. That's perfect. So, could anybody in here name the specific type of capital that you're raising? Not the actual values, not the amount you need to raise. What kind of funding are you actually raising?
Most VC, I guess like VC.
VC? How are you going to get that VC funding?
Applying to the VCs, connecting with them, talking to them, building relationships. So then finding out which ones are the right ones for me.
Absolutely. So when I think of VCs, I automatically think of Satos. I think of a particular tool and an instrument of how to get that money from a VC. And I think that's one of the things I wanted to make sure we educated people on. What are some of the misunderstandings and misconceptions about raising funds in this day and age? Because we don't have those hand-to-hand relationships. It's not as much, I love your idea, cut and check, bring me the paperwork later. What are you guys actually seeing right now? What's trending?
Yeah, totally. So, hey everyone, Brandon Bartoli here. I started Prosper about 6-7 years ago, and I was a management consultant before that. So I really was advising companies on how to grow and scale all throughout my 20s, and then my 30s is all Prosper Firm. And long story short, the biggest thing that I noticed a gap in is really just the awareness on all the different types of capital and what that looks like, the pros and cons of debt versus equity, and then within equity or a combination of debt and equity. And then there's just so many different ways you could structure things nowadays with buybacks. And there's just so many components that we could walk through that gets extremely complicated. But the simple version is that I think that's the first thing, that before we even just get into like equity specifically,
Do probably those are close to go.
is it because we are close?
That's a route. All right.
Santa on
You're stepping on a court.
Yeah.
Hello? Can you hear me? Am I still on though?
Yeah. You're good.
Okay. Oh, all right. Sweet. Sorry about that. I want to consider train of thought back to it. Difference between debt and equity, I think, is the first step to understand, because I think a lot of people just initially think equity. Like I need equity, I need capital. I want to exchange equity ownership in my company for capital. Like that's, I think, what most people are initially thinking. But there's just so many different things that you could do and how you could structure it. And a lot of people, they don't look at the debt component as well, which I think could be extremely valuable because you're not giving up any equity in your company, right? As long as you could sustain like payments, because that's the downside to debt. Obviously, if you get an SBA loan, you have to worry about monthly payments that you have to make sure you're keeping up for. So if you're pre-revenue, that could be hard, because you're taking on all those payments on the front end. But there's a lot of misconceptions. Like a lot of people think that you can get an SBA loan if you're a startup or you're free revenue or whatever, but that's not the case. I got an SBA. I got a 1.2 SBA loan for an assisted living facility that I did. That was a complete startup. So anyway, so all that's to say is that that's the first component, I think, is just folks starting to have more understanding and education around the different types of capitals that are out there. And obviously you can do your own research, but then that's all obviously part of what we can help with too and consult with. Because since I have a consulting background, I started this company not just to be an introducer and connect people to the right capital source, but also to help advise and navigate them through the process, right? Because there's just so many gaps. Like, you're really good at whatever you do, whatever your niche is, might not necessarily be really good at the capital component, right? So that's what we're trying to help solve.
And Priscilla, before I pass it off to you, I want to just give some information to everybody. In the first half of this year, 2 companies, can you guys guess which 2 companies on popping there? OpenAI and Anthropic took roughly 43% of all global venture capital by one estimate. 43% of VC money went to 2 companies. Seed funding fell 27% nationally. First-time fund formation is pacing to its lowest year since 2016. And most of the hands that just went down are about to spend 9 months asking the wrong people the wrong things. So, Priscilla, you guys are not just in the venture capitalists, and I'm not just gonna let the room pretend you are. You lend, which means you are the only person on this stage who can tell them the thing they don't want to hear. How many of the founders who come to you asking for capital are actually asking for the wrong instrument, and what does it cost them in months to find that out?
Hi, guys. I would say, and I no lie, a couple of weeks ago, I took about 20 calls for just smaller companies within the looking to raise 5 million to 10 million. Some of them looking to raise 500,000 or $1 million. About 80% of them were not aware of what they needed. They were not aware. You go out there or you go onto ChatGPT and you're like, okay, I need the basics. But it's working with investors and bankers that I have for 4 years now, and putting together like equity debt hybrid components. They're not aware of how much is needed and how it can be phased out. So for example, let's say, I had an ice cream shop for 500,000. Well, in reality, they needed more. Well, but they're like, no, I only need this right now. So what we do is when I structure, I'm looking at what's the shreds. Another thing is financial model. We have another one that just came. It's a $5 million raise for medical. Medical and AI is always the way to go. There's funding out there. It's all in the way you structure your presentation which is what we do, to your bankers, your investors, I work with a lot of equity components like overseas. And one thing that they look for is how strong in your projections, right? They're also looking for what stage are you on, how much risk there is in this, in the business, and how much, how do I say this? Like how much risk there is, and what the financial, yes, yeah.
So I guess, what do you guys understand? The reason why we partner with Prosper Firm is that even though they do work nationwide, they made a commitment to focus on Tampa Bay region companies. Like in Tampa Bay region, in the surrounding 5 to 8 counties, depending on how you look at it. So you're talking about Pasco, Pinellas, Hillsborough, Manatee, Sarasota, and then you get into Citrus and other counties. But Brandon, from some of our conversations, I wanted to ask you, from the work you've done in this region, whether it's good or bad, but I need you to be honest, what do you find that is the single biggest lie that the founders in this region are telling themselves? What's the biggest misconception that you're sort of right to?
I would say the biggest misconception is just what's available to them. That they just don't know. They don't know what they don't know, right? And I think it's we've already very quickly here made it pretty obvious that most of the people that we come into contact with just aren't aware of what's available to them, and that's not to their fault. It's just that there isn't a lot of predominant education and awareness around different types of capital and so on and so forth. It's not their fault, you know. So that's what we're trying to solve and trying to break down some of those barriers of like actually creating, like doing something like this and so on and so forth. Like we want to start to break down some of those barriers because I think a lot of people come to us thinking they want equity, but then we get into deeper conversation. They're like, actually, we would prefer to go debt or vice versa or whatever they can. Like it's just that people, they just don't know.
And we jump into that debt part.
Yeah.
So from the other side of what you just talked about, what does debt cost the founder who takes it too early? And how many of yours have you watched this get hurt by it? So some people, they go to debt route, but they probably should be just waited a little bit longer to build the business out. So how does debt maybe hurt someone? We want to tell, we got to see both sides of the story.
Yeah, 100%. I think we could probably both speak to this. Yeah. So I mean, we obviously have seen debt not go well. And I think that's what a lot of people are afraid of debt because you're thinking, you know, this could go upside down. If I have to personally guarantee this, like there's bankruptcy, like there's, you know, there's very real consequences if you don't perform in a way that gets you above it, right? So like I think that's the significant like risk that you just have to make sure you mitigate and you have the right plans in place for it. You have your strategy down to a science, and that's where I think there's some people that come with us and they have like really good ideas of something, but they're not far enough along in the process to be competent in actual execution and traction within their business.
It's funny you mentioned that because I was just about to ask Priscilla that. I've noticed for me, a lot of the companies that I've started kind of mentoring around accelerator and incubator aspect, a lot of them are not even venture or debt free. They have business ideas, but if you really look at it, a lot of people have business ideas with no business behind the idea.
100%. We get people all the time that will come to us and say, like, I have the best idea ever. I need $5 million. And obviously, yeah, like it's hard. It's hard to navigate that was like super serious face. But anyways, like it's just, you have to have a plan in place. You have to have a strategy. You have to ideally have a proof of concept or something, but like you can be pre-revenue. Like you've been able to help pre-seeds. Like it's not that it's impossible. I think that's another big misconception. Some people, they think that, you know, I don't know that pre-seed can't get capital. But it is possible. And we're in the process right now, just in the past like month that we started trying down here in the Tampa Bay area with like some of these specific groups. I've been able to start to get them down that pathway of being able to access capital pre-seed.
And I think one of the companies that Priscilla was working with, $5 to $2 million, I know that one, medical company. Yeah. They were looking SBA at one point and the reevaluation, and you were able to help them find funding. But their score, their vision of how they were going to acquire money and clients was very well defined.
Correct. Yeah. They already had a proof of concept in place. They already had like different use cases, test cases. They had so many things.
So tell me about Priscilla, when you were working with them, like, what did you see that made them kind of stand out? Because the company is going to be amazing, but it was a quick transition once you all like.
Yes, they're well structured. So when we're looking at a pre-seed, a lot of people are like, okay, executive summary, your demos, your executive summary, your business plan, their business plan. And they also have, besides this startup, they also have experience in this field. So they come with referrals, they come with sources. That's also something that investors look at. How well and how quickly is this going to take off once I invest? Their pro forma, it's a well built off pro forma, had CapEx in there. They're very well put together. So it's easier to acquire. Also, pre-seed does not mean that you have not invested. Investors are really looking to see how much you've invested into your dream. It doesn't have to be $1 million. It doesn't have to be, but they have to see that you have skin in the game as well. That's one thing that they're really looking at when I'm compiling and, just reviewing. It can be pre-seed, it can be startup, but they're gonna, okay, this startup, it has a demo. If they have a client base, even they might not be paying, they might be examples, but it's in their, like it's in their dynamics basically in how it's being structured.
I remember one of the key things in the 2 battle we were raising funds, they would always say, the first question would be, are you working on this full time or do you still have a job? And it was actually a trick question because sometimes they wanted you to say, no, I'm working on it full time. But other times they wanted you to be smart enough to know that you still need to be making money to actually invest your own fiscal money into the time. It could just be your time. Some people think, well, I'm fully dedicated. No, they want to see receipts. They want to see, have you lost money and actually have you spend money themselves?
100%. And it's just like anything else. Like if you're trying to get capital for buying your own personal health, you know, like you have to have certain parameters in place, right? Like there's credit score, there's, you know, just like your personal financial statement. Like there's basic things that like, again, you don't have to be perfect, but the more that you have in place, the better the capital is going to be. It's just like anything else, right? So it's good for, I think a lot of people miss that too. Even when you're going like the SBA route or whatever the case may be, that like, it's good to be working on your personal credit still. Yeah, it's good to like have some of these things in order. And if you don't have a good credit score right now because of X, Y, and Z, work on it, you know, get with a credit repair person, do things that can start to elevate you to be more attractive in a way of giving you money, right? So that like they look at, investors are now more than ever starting to look at the whole picture holistically. You, your company, your idea, like where it can go, the market penetration, or just like what is the market share, like all these different things they factor in to be able to say, is this something I'm willing to invest into or not? And transparently, it's pretty similar on the debt side too. So like when you're going SBA, and there's other loans outside of SBA, we've been talking a lot about SBA, but there's a lot of different things, the different loans and things that you can get outside of SBA.
So we're focused. This is a hyper-local mindset.
Yeah.
We're focused on this region. So I would really want to know, where are the investors actually putting their money right now? Because there was $300 million was put in the Tampa Bay in 6 months. Most of it was in cybersecurity. What other sectors are you seeing that are making money, and how are the founders getting there? Because you don't do a venture callback, you know, so cybersecurity is still hot. What other sectors, and I'm actually going to take, I want to go a little bit further. I'm going to take med tech call. If I remove med tech and I remove cybersecurity, where else is money actually going? I got a row of founders. We're going to put this up on the internet. This is my camera. Where's the money going?
That's a good question. And I will start with medtech. True, it is. But just tech in general. Tech in general is really good right now, like all tech across the board. It doesn't have to be healthcare, obviously. If it is healthcare tech, that's like top of the top.
Yeah.
But yeah, tech in general is really good. And that there's other sectors too, like even just who like you could go deeper within tech, but like tech in general is at the top. The only other thing that's at the top outside of tech is like real estate. So like there's a ton being invested in real estate development and so on and so forth. And just the whole real estate space in general is like huge, obviously, from an investment perspective. But tech is also huge. So I would say those are the top, but there's manufacturing, there's so many different industries.
I was wondering if you want to mention manufacturing, because that's a whole.
And there's a combination, like obviously there's data centers where it's like real estate combined with tech and so on and so forth. So like you get all those different variations, but manufacturing's a big one, tech's a big one, real estate's a big one. I would say those are like some of the like real big popular ones, but there's always variances to that too. So.
Anything you want to answer? The line. Manufacturing is really big. Healthcare, infrastructure. With infrastructure comes your data centers, your energy projects, and businesses that are like revolve around these sectors for infrastructure. The investors are highly keen to invest, even if it's pre-seed. They're like, oh, this is interesting. Why? Because it has longevity. It's kind of like, not sure if anyone here is familiar with crypto, but you know, Bitcoin. Bitcoin is It's very popular, and a lot of big money from across the pond invest, as we know. Same thing here with the infrastructure in the U.S. and energy projects are really big, and with those you have the businesses that were involved around those infrastructure and energy projects, data centers. Those are the ones that they're really getting in money that you'll be able to raise money for easier.
Yeah. And I would say one more thing, just as a concept, like there are other really big industries that tech is starting to become more and more involved in. Like for the example, I think we all know that oil and gas is like a pretty big industry. A lot of money goes into that, so on and so forth. But like we just got an opportunity the other day that these guys came up with a way technology-wise to automate so much of the like refinery process that they can reduce the like current amount of staff by like 75%. So like whatever the tech is that they're putting in place on these rigs, it eliminates 75% of the workforce that is typically there, which doesn't sound great from a workforce perspective, but it's really good from a tech perspective. So this is a tech one. So that's a good thing for tech. But anyways, like
Hold on one second before we move forward.
Yeah.
So by Tampa Bay Tech Week team, go loud. I can hear you. Control the room, please. Let's bring it down in the back. That's what the network of the business for. Okay, thank you. I tried to text you, but you didn't respond, and it kept getting loud. All right, continue.
You're good. That was my point in terms of that stuff. There are big industries like that. Again, if you're looking for opportunities of like, if you're good with tech or you have different ideas like that, there's so much opportunity, especially when you start to get into some of these big industries that a lot of money is going into. And if you can be a tech component in there, like it's a pretty good sweet spot.
So being honest, if you're looking for BC funding, I just want you to be as honest as you can. If you're not doing cybersecurity, if you're not doing AI, you're not doing defense, is there actually venture capital money right now? If I know 47% of the money is going to 2 companies that are AI companies, is VC money really an option if you get outside of those 3 lanes?
Yes. So money is an option as long as you have a good business. So it doesn't matter what your business is. It could be literally anything. And like, it could be, I forget if we were just talking about this the other day or something, like there was like you were talking about an ice cream company, but there's like an ice cream tech company.
Yeah.
That they have technology. Anyways, long story short is that it could be anything, as long as you have a good business and not just a good idea. That's why I wanted to structure it. It's not a good idea.
Everybody's curious. What the ice cream? I don't know.
EBMA, dog walker, you got them like the one industry, one small business that they can remain is they call them the dog. Yeah.
The little, now is this a robot or is this a human walking around taking up shit?
Yeah. Some of them use ours and they're just
Robots. Volvo's robots picking up.
I was thinking a robot dog walker, but
It's better than me.
to an investor, sort of $5 million for someone that for a pre-vans he's expanding, and that's another growing.
Yeah, it could be. I'm telling you, it could be. It's
literally don't say hire the children or the dogs.
But to drive into that just a little bit further, to provide some substance, is that, like, again, it's not just a good idea, it's a good business. Like, you know, if you already have proof of concept, if you have maybe started to get an initial client base, and maybe it's not in the hot spots, that's what I'm talking about. So like, if it's not like a hotspot type thing, but you already have a proof of concept, it's proven, you have some kind of track record, you have a background in it, and you have a fully baked out plan and strategy to go from level A to B to C, so on and so forth, people are going to be willing to give money to that whenever there's clear return. You know what I mean? It's just like anything else. Just think of it as a loan. When you lend your friend money, if there was extremely clear return on you lending them money, you know, and if it was completely foolproof and you know if you're going to get it back pretty quickly or whatever the case may be, it depends on what you care about, but you're probably going to be willing to lend to that person, to your friend or your family member or whoever. It's the same concept. So it's like, if you have something that's pretty bulletproof from a lending or just capital deployment perspective, you can get access to capital.
Okay, so we're going to test that. So we're going to find your lane, your staging instrument, and the cost of guessing wire. So I think one of the things I like to do is like, well, tell it a lightning rounds. So everybody here, a lot of people are never going to admit what they don't know. We know that to be a bar. So you educate. So I'm going to give you a mechanism, get the funding, and you're both going to give me one thing that you can think of that automatically disqualifies a company from getting that lane of funding. Okay, we do that? All right. So if I'm an equity company, what's my one red thing? What's the one thing that would just tip me off relying on giving equity? And I'm also give my feedback too. So equity, what's stopping me from getting funded if I'm looking for equity funding?
Absolutely no financials. No financials. That's the one red flag. It's like, and a lot of people, financials come in many forms, but if you have, as an investor, and we're going to, whether it's a special vehicle that we're using, a note, there's many ways to deploy this equity. Escrow accounts, for someone to come and we're like, okay, we're going to give you, we are like, yes, this is a good concept. It's strong. And we ask for financials and no pro forma. There's no pro forma, no financials. That is a big red flag.
Yeah.
That's that's like one.
Remember that, guys. Have your performance. Yeah. Well, we want to add to the other funds.
It's similar, but it's just a plan. Like, you have to have a plan in place. Like, you have to have documentation. You have to have like your pitch deck. You just have to have basic things in place, right? Like documentation, a plan. You're not going to get equity funding if you don't have a very clear, concise plan of what you want, why you want it, what are you going to do with it, and where's it going to go, when is it going to come back, or whatever the case may be. So
For me as an LP, it was actually diluted at the. I would hate when I would see somebody come to me and I found out that their cousin owns 30% of their company. Yeah, and they give them like $5,000. And people don't actually calculate those numbers, how much that devalues your company. So be mindful of when you start giving away equity in your company and you start letting an advisor buy in or somebody buy onto your board. Those things come at like 0.5 or 1%. Those things are not 10, 20, and 30%. If you dilute your company, it will come to bite you in the ass and you will have to restructure your whole company. The next one would be debt. What's the red flag for debt?
I mean, the obvious easy one is like bankruptcies and felonies. It's like a hard one. It's possible. It is possible. I mean, I've helped people get loans that have had like bankruptcies and felonies before, as long as that can be explained, or it's been a certain period of time, like 8 years plus, or whatever the case may be. So it's not like, if that is you, that like something has happened in the past, like it's not like it's impossible. But if it was recent, it's probably impossible. But if they can be explained, like I've had people get in trouble with the law before, but they can justify it of like what happened. It's totally irrelevant to like what we're doing here, and it could potentially get through. But those are usually two big ones. It's like bankruptcies and felonies. That's a pretty easy one for debt.
Yeah, low credit scores, especially if you have mortgages out there and you miss payments and you're all over the place with your income to debt ratio.
See, I was going to say, I've never had to do debt. But when I would advise people, for me, it was if you had absolutely no appreciating assets. Yeah. So appreciating assets means you haven't invested into the stock market, you have no retirement, your savings is not in the high yield savings. I just see nothing where you seem to understand the concept of saving money to make bird.
Yeah, so I agree with credit score. But it's with debt, here's the easy thing to remember is the 3 C's. All they care about is either credit, collateral, or cash flow. Those are the 3 things that every lender from like a debt perspective looks at, and every lender ranks those 3 things differently. Some of them care a lot about credit. They don't care at all about collateral, like an unsecured loan, but they care about cash flow, right? And vice versa. So like it's always a combination of those 3 things of credit, collateral, and cash flow.
Yeah.
And just depends on what lender. That's why it's helpful to go to a brokerage like ours that has access to 2,000 plus lenders, because based on your very unique scenario, it's hard to, most people will go to 1 or 2 lenders and they tell them no, but that doesn't mean that you can't get like a loan. It means that they don't like your 3 C's in that order. Does that make sense? You have to go somewhere else that actually has them in the right priority for you.
That's how I get drips. I think cap, collar, and chinos. Like, don't know. So, what about, so would you say that private lending kind of has the same profile as debt? Okay.
Yeah. So all lending, all debt, they care about credit collateral, cash flow. It's different. So like private lending is going to be like, think of it like, look at that differently than banks do, and then again, big institutional banks like Chase are going to be looking at it differently than like Suncoast, so credit unions. So every lending source is different, but they all care about those three things in different ways.
Now, we talked about this earlier, so I still want to know red flags, but some of you may not have considered this. Grants are another way to get funding where you're humming, especially if you're doing something that solves your problem for the government or other organizations. So what do you think are some of the red flags for those that are going after grants?
Well, I mean, a lot of times it's not necessarily red flags, but it's more of a qualification perspective of like, if like, obviously there are a lot of minorities that could have access to grants from that perspective. So, which is great. So it's like, it just depends, but the type of grant you're going after, in terms of what you're going to qualify for, but they have their parameters and it's usually very straightforward. Like they make it pretty obvious of what their parameters are. So you could pretty quickly, I mean, especially with AI now, like you can have AI vets like what type of grants you probably would qualify for and cut down on the downtime because you used to have to do that manually. But they have their boxes that they care about, but yeah, that's my simple one. You should actually talk about too, the grants are awesome and you should absolutely tap into that. But then even like tax credits and different things like that. So like Priscilla's actually done a lot of work with some of these different tax and tax credit components that I think a lot of people just have no idea around.
Tell us about it. That's what they're up on.
That's a great one, honestly.
Well, thank you. So I worked now 4 years, but government tax credits, like ERCs, those are dying down right now. But another big one is your R&D, research and your R&D credits. Research and development. You have your solar, if you're into energy projects, you have your solars. Those are actually assets also that can move, that would look good on your, I call it your financial resume. But those are other things also. So, and one thing is like if you're selling your company or you are, let's say, for example, and with the tax credits, really focusing on like the research and development, a lot of companies, especially mid-size or even smaller companies, they do not know that, if especially in tech, your research and development, especially as a startup, and you are really, those are certain, you have a certain amount that's designated to you that you can actually, once you fill out the, there's like a whole packet that you would have to fill out. You would submit it over, they would approve it, the IRS would approve, and then I, or one, and someone that can purchase. I have investors, bankers, private lenders that would turn around instead of you waiting 2 years, 3 years, 4 years to get these R&D credits once it's approved. Turn around tariff, I do tariff buyouts as well. So if you have like, you're importing and you have a certain amount that you've imported and you are on the goods of the invoicing, we can go ahead and get you paid out there too. Yeah,
the whole process from a tech perspective, like since again this is very like tech focused, there is a lot of opportunity in tech to capitalize on some of these tax credit type things. Like you could talk to Priscilla about it afterwards. But we've partnered with like a law firm that's what they specialize in. They're really good at it, so on and so forth. So yeah, it's a big opportunity, essentially.
Don't want to do with my R&D now with my deal. So now's your chance. You're here. So we're going to have that conversation now. So tell us about your great. We're going to do it different though. I don't want you to give me the hypothetical. I want to hear about your company. Why are you pre-revenue? And what kind of funding would you be looking for? Come on, right. This is what a pitch competition should look like. Let's get to the bag.
Okay, so what we do is use technologies. We're very careful about the AI we're because a lot of owners, get skeptical about that. They implemented it and lost money on, or they're trying to do it themselves.
Sure.
And so, our background, sweet spot in my background, then we have our chief technology officer there. So I do a lot of business, she does a lot of the technology. We have a lot of products that we beta tested ourselves. We have a couple of proprietary processes. And we're really, right now, we're looking at VC funding. And there's something actually as I had there. But how important is that proof of concept? So we can say, here's a concept. We've tested it ourselves, but that's only with ourselves. But we have all the other strengths you're talking about. So how important is that for this first client? Do I make them paying, or do I just use them as a proof of concept that then they can keeping this feedback?
And you're talking about how important is it to have a proof of concept of like your business, or a proof of concept of a VC giving you capital? Proof of
Let's focus on VC.
okay, yeah, because I was going to say, like, if you have a proof of concept for your business, it's a really good thing and puts you in such a better position to be able to get capital. So that's like first thing. But second thing is if you do, if you have already secured funding from, a VC, so on and so forth, and you have a proof of concept of like getting funding from a source, that is also potentially a good thing. It isn't always necessarily a good thing, but it can be a good thing in the fact that somebody was willing to give you money in exchange for whatever the arrangement was. But it could be a good thing. But again, it could also not, like they just don't want to. Like you might have another VC firm that they don't want to be second fiddle, or, like almost like a second lane behind the first investor, or whatever the case may be. It just depends. So you might take out some capital sources, having proof of concept, but then others would like the fact that you've already secured some funding. You know what I mean? So it's pros and cons. It's just a matter of, again, there's no shortage of capital and funding. It's a matter of finding the right ones, which is the hard part. So it's just like going out deep sea fishing and you're just throwing a fishing line in the water, like hoping you're going to catch, like, are you trying to catch anything? Or are you very specific about, like, I'm trying to catch like redfin tuna in this particular area for this particular reason? Like there's just this, it's the same kind of concept that most people, they're just going out to sea, throwing their little fishing rod that only goes 10 feet, thinking they're going to catch a whale. And it's like, brother, you're not in a position to, you know what I mean? So like, it's that concept that it could be good, it could be not good. I hate giving you the answer, it depends, like an attorney, because I'm not an attorney, but attorneys, that's how they always answer things, it depends.
I was going to say, and this would be structure. Yeah. So it's fun. The one thing I was about to say, and this is for all the founders in here, my advice to be, when you have those opportunities, this is for everybody. This is a mistake I used to make. When you have those opportunities, learn how to hone in on your conversation and be specific. Let me tell you why that matters. People at that caliber look at anywhere from hundreds to thousands of things every week. The problem I see with most founders when they come and tell us about their ideas is fake. And it doesn't help. And the thing is, we all think, I feel this way. I still do, but I just know it not to be true. We all think we have something proprietary. The only thing right now in this world that is truly proprietary is you. You're the only thing that cannot be duplicated. Everything else can be duplicated, stolen from you, whether you have a patent, a trademark, a copyright, or whatever. But if you want to get to money, you need to learn how to be specific. I do this. It solves this problem. I plan to make this amount of money. I need this amount of money. Let them start to ask the questions. Do you see in that exchange how Brainiac had to debate because he couldn't have that much to grasp off of? The only thing I've always said, I will not do my panels like everybody else. I don't want you to just hear us. I want you to learn. This is a learning opportunity. You have to say, this is what I do. I don't care that his CTO is his wife. I told them that earlier. I don't care if you're married. They don't care either. Actually, some people will see that as a conflict because they're worried if you have to make a hard decision to fire your CTO. Can't you fire your CTO and live in the same house with her and expect her to cook for you? That's actually what I have to look at as an investor. That actually, for some people, might be a red flag versus for others, they're like, oh, they're going to be in it together. But I can tell you, a lot of money doesn't move with a, oh, kind of face. It comes with a, how the hell am I going to get my return? How do you 10x my money? And what do you do when I tell you she's not going to cut it? I need you to bring in Thomas.
Yep.
I'm sorry, you're not his wife. You know what I meant? She could be yours. This is what it looks like, right? But that's where the clarity comes with. So we're going to try this one more time.
Well, and before we jump into it one more time, just to belabor that point real quick, is that I've actually had to jump into doing like advisory and coaching with clients for this reason. And that's not even like necessarily that wasn't supposed to be part of our business, but it started to become part of our business. And I started to have to almost charge for it. Because that's seems to be one bottleneck or roadblock. It's so many people getting access to capital. You could actually have a good plan, a good proof of concept, but you don't know how to communicate and deliver a pitch and so on and so forth. And like it's a big deterrent, like from investors.
So yeah, so now Priscilla's going to respond. So we're going to try this again now. Tell us what the product or service is. Tell us what problem is solved. How much are you going to charge for with this one client that's coming out, and how much money do you need? Go.
Okay, so the product we have is we can go and assess through our diagnostics to see if the AI that you put in, look at your EBITDA or look at your key KPIs, which ones are a pinch point that we can then help you either reduce exposure or increase value.
How much are you charging for it?
So this current is the way that we've structured it is 3 phases, 25,000 total, and 7,000 per retainer por ellos. Yeah. So basically, at the end is the customer. I said, I'm very happy. They've had minimal, investment, and then at the end, if they're happy, then we'll be the ones who put it in. We're the ones that then
Go to how much money do you need? I'm sorry, how much money do you need?
I need at least to start off about $1 million, because I need to pay for an SDR.
And how much money will you make in 3 years?
I think we'll make that if I have an SDR and we have
So $300,000 a year over year. What you look at?
Yeah.
What do you think? I'm saying your mom thinking up, but she say ups.
Just when you said it, and you said, the million, usually for that phase. So I would go when asking questions, and I would go work your model. And first thing I would say, I wasn't clear. So you're saying it's 7,000 per
7,000 per phase. Well,
per first phase? How many phases are there? And like how?
3. So 3. That's 21,000. Where's the other $4,000 come in?
so the just a initial down payment.
Okay.
So 4,000.
So it's a setup fee, $4,000 initiation fee, research and development, $7,000 of 3 phases, implement. I'm sorry, guys. I went there. So $4,000 for initial deposit, services, evaluation, $7,000 per phase. So $21,000 in services, $4,000 in consultant fees and setup. So that's $25,000.
How long are these phases?
Probably pretty quick, but
Probably pretty. What's how many days? How many days or how many months? This is we're training.
you're talking just a week put in there. Okay. They're gonna think it's probably longer to say. So the one
Hold on. Come on. 30-day turnaround. Okay, so 30-day turnaround. So we're looking at a net 30, so probably 90 days before you actually have the revenue back. Y'all see how I'm doing this?
And have you done this? Do you have a proof of concept in place? Do you have clients yet or not yet?
We don't have one. That's where
They have prototypes, what client on the way?
Have you had third parties tested at all? Like any other independent people? Have you allowed anybody to do like a free demo, like things like that?
I have a full QA and it said works on it.
Okay, cool.
And you're stating, I would evaluate it a little more, and I would, you need more. You need more money. So you were to be looking at, and this is something that happens with a lot of first time, with founders. You're looking at the immediate need, but you're not looking at, so when you're looking at financial, right, you're looking at your structure, your employee, your scaling ability. So one of my questions would be like, how many would you be able to get done in that 30-day? So like if I was to, for example, 10 clients, if I was to give you 10 clients, how quickly can you get that done? That all goes into your financial model per se. That there would, for me, from just this, you right here in this small explanation, I'd be like, first, you need more. And it's also how we would structure it. Review, I would structure in some type of, I would go to one of my investors and do like a structure in the either an escrow type, or we can do, it's different types. So you have SPDs, you've got notes, but an escrow type where it would actually work, and I've done this before, like a line of credit. And you would be able to take from there. This is only equity. We can get very creative with it, but we would need to see your structure. And one thing is your model. So from what we gather here, you don't need one, Nelly, you need more. And we would do that in phases. So just also so that people can get a clearer picture, when you are asking for, let's say 50 million, right? I've closed transactions, 260 million. The investors, the banker, they don't say, here you go, 200 million on the table right there. They give it to you in phases.
Right.
So they're going in and they're going to be auditing. They'll be doing a strict audit of your books. They're going to be doing a strict audit of your books. They're going to be really looking at where and how much the company has grown. And they could put you on a quarterly model. Depends on your risk. If you're de-risking, if you collateralize, it just depends. Every quarter, every 6 months, once a year, as your company grows. And then they would allot you, more from at that time. But that also, you got to narrow down what is it that you'd be able to take on at the very beginning.
Yeah.
So if I'm,
And use of funds. You know what I mean? So that's the
That makes a view. So I want to add to that because I spoke to
use of funds has to be there.
the young founders over here that are getting ready to launch their $1 billion company. Most people don't want to hear you sell the $1 billion dream. I know it sounds weird, but I've had more companies that we've turned away because the amount of money they asked for was not enough. And it's like, oh, we only need $150,000. I'm looking at a $1.2 billion company, and you're telling me you're going to go to $150,000? Either I'm going to fail or your bag is off.
Yeah.
And you have to dream bigger, but you have to get more precise with these conversations and understand how the money flows. Now, as more of a nerd of the data sciences, I would say the biggest thing is you should have led with the case studies and the assets that you're talking about with proof of concept. That wasn't detailed about. If you know that information, you have to say, it's all how you sell something. I'll tell you one of the best pieces of advice that I got from a financial guy. When I was trying to balance my books, and we were talking about our business, this was my marketing agency. He asked us our year over year. I gave him a year over year. Then he asked us, because we were probably 16 years old at that point, he asked how old was the company. I was like 15, 16 years old. He was like, oh, so you were a multi-million-dollar agent. I'm thinking to myself, I don't have multi-billion dollars in the bank. That's not how money works. It's how much money can I continuously make? How much money could it bring in if somebody was to say, I want to buy out your marketing agency? If you don't know how to talk money the right way, they will look at you different. And they're only going to do one or two things. Teach you or pray you. or ignore it. It's not a lot of fair game. This is still a dog-eat-dog world. They're still trying to make their money. So you guys have to, and especially when you start getting into AI. What I actually heard was an AI governance system that actually audits people's systems. That's why it's, how far off am I? Just a theory.
That's L.
That's L1. So there's either a missing in the pitch, which means you got to get that pitch better, much more tighter. And then the next thing I heard, when I heard that, I was like, oh, there's about 17 others of you that just came and talked to us. Points of separation. Points of separation don't just help you with pitches, they help you with funding because that leads them down a different path to make their path more specific. If you can't be detailed and specific with what you actually do, don't expect somebody else to do it for you, unless you want data. Those things come at a cost. Thank you very much. So this is a bit. So, is this a 4:30 on? I think it's just till 4. Or, we're supposed to go Greek and network now. But I want to get at least 2 to 3 questions in that y'all and I. Y'all, yep. What's over, y'all? Anybody else? Oh shit, y'all got more than 2 or 3. I said, I want to come back to them. I'm going to walk around. So as I finish with one person, raise your hand up. Is that time of the day you are for depression? Just call. Just raise your hand after I do this play.
Thank you. I have a question on, I think I know the type funding we're looking to do with it. So that we have some precedents that I'm curious if it has any way to merit going forward. So I'm a Parcio, I'm a founder and CEO. We're a recreational visibility and intelligence platform. We allow the people, the community to know where they go, and then allow the government, the facility, to have some analytics and intelligence on the back. We have per concept, we have about 28,000 users. We're in 30 locations across 4 states and have about 30K in ARR. At this stage, what type of investor would you target? I think it's angel is what we're looking at, or is it I think we're at a C round and we're at a C stage. And then how did our prior investment from friends and family affect the valuation for this round? We got pretty lucky. First die in this, the big, that's what it was, 4%, and it was about 200K.
Okay. And I didn't hear the one piece of, are you generating revenue currently yet or not? Yeah.
About 30K overall.
Okay.
And 7 years at this rate before they pay back the angel investor.
And are you, of that, are you profitable yet or no?
Very close. If our ad sales team kicks a year, low a year, a market to rate.
Okay. Yeah, I mean, when you talk about angel, obviously angel is the biggest and easiest demographic to be able to like capture in that stage. But it doesn't necessarily have to be angel. It could be family office. It could potentially be VC. But it's typically going to be angel, like 9 times out of 10. But there are some family offices that we have access to, like that kind of stuff. They could potentially, like, you could go a family office type route. But angel is probably the most common answer to your question. Similarly to the second part of it with the family, I wouldn't say it's a complete, like it's not like a deal breaker by any means. You said it's 4% is what they have. Yeah. So that's not a deal breaker. If it was like 30%, then that might be. But at less than 5, I think you're in an okay place. Plus, you can always mitigate stuff like that if you have a plan. Like it's like or even if it's like, hey, we could, if we get this funding, we could potentially exit them out. So make it clean, so on and so forth. Like if you're open to having them exit sooner rather than later, like you could do that. You can mitigate the risk by having a plan in place, at least for that. Like, hey, I'd prefer to keep them on, but if needed, we could buy them out, you know what I mean? So on and so forth. So it's just having a plan, making sure everything is explainable, and it's not a deal breaker, but it'll at least cause a few additional questions.
Okay, the last was it the elbows. How much merit weight previous investment we had again? A person investing $50K upon a ship. You know, setting a ridiculous.
It doesn't ship too much because you're still at 5%.
Yeah. So, yep. Totally. Yeah, 100%.
Hello. I'm just starting out, so I'm planning on for the next 12 months bootstrapping. My company is registered. I didn't know what I was doing when I started, so I registered as a Delaware C company. I'm a foreign entity in Florida. Like, I have the demo, trying to work it out over the next 12 months using my own money. But where do I get the correct mentorship and guides to make sure all of my financials are in order? So 12 months from now, I'll be ready to buy it, and I'll be all set.
Yeah.
Dude, set this up as a workshop and just do another seminar and let people come and sit here. Yeah, take it. Yeah. So we'll put together an actual workshop and a seminar, and we'll re-invite everybody else out here. So we'll do a working demo. So we'll just get a sponsorship to pay for their time, and we'll invite like 20 or 30 people out. It'd be all send everything to us in names. Would that be cool?
Yep.
All right, well, let's
Yeah, the real short answer is that there are either firms, advisory places, consultants that will potentially help. We can potentially help with some scenarios like that, but with some of the advisory, some of the structuring, but it's usually just the cheapest is like the smaller boutique like firms or individual consultants that would specialize in that, or fractional CFOs, or whatever the case may be. There's multiple options you could go with, but we could potentially help.
Thank you guys for the session. Very informative. Earlier, we talked a lot about where the funding is go. AI be a big space, and the venture capital space it's there, and PE space it's there. If I'm a founder starting out, then I want to maximize my valuation. Obviously, the valuation multiples are on the AI side of things too. Are there certain thresholds or attributes that you will look at a software company that will fall more into the AI multiples versus a traditional SaaS? Is there groundwork there for what that threshold is, or is it still very much a gray area at this point?
Do you want to answer, or do you want me to go? Yeah, it's very gray because it's late. It's still very gray, but so there isn't anything that's like clear cut to level up necessarily. It's still pretty gray. But the one thing that I will say that I've seen a lot more is that valuations now are going less in the direction of just like an EBITDA multiple, and they have been going a lot more in the direction of a pro forma, which is also. I've just seen that a lot just over the past couple of years, that it was always just based on EBITDA multiples, you get 3x, 5x, 10x, etc. But now I've seen a lot of companies sell for what would be like a 50x EBITDA multiple, because it's not based off of an EBITDA multiple, it's based off of pro forma and structure and capacity and market share and so on and so forth. So I will say that's the kind of the neat caveat that is happening from that capacity.
Hey everybody, I work at Baker Tilly, which is a CUA firm. I know we've been talking a lot about personal finances, so I just wanted to give a tip for the group. Open the business bank account as early as you can if you haven't already, because the biggest and hardest part is cleaning up the separation of personal and business. So that's the first thing they're going to look at. So I wanted to go backwards a couple steps and just advise you, open the business bank account, start delegating different expenses of business versus personal, because that's going to make your time and money spent on an accountant way easier if you do that at the beginning. So just a tip for everyone.
So they need your main. This is your initial appointment that you set up while you wait on our workshop. Because that's very true. Yeah, let's want to separate.
100%.
I think this was the last question in there. We're going to roll network. Go ahead.
I just wanted to know for the pitch deck, what are your top 3 things that you want to see? What is the one thing that you don't want to see? And what is the way that people getting in contact with venture capitalists? Like, do they see the emails? Is it they look at the application?
Yeah, no, good question. The number one thing that I'm looking for, that honestly, it's terrible that it's hard to find sometimes, which is the ask, like, what do you need? So like that's the number one thing that has to be in every pitch deck is very clear. What is the ask? What is it for? So on and so what's it going to go to? So like that goes back to like the use of funds. What are you asking for? What's the use of funds? Like all that has to be extremely clear and defined, versus it being hard to find or ambiguous. It's just that's my number one. If you want to know more, I can go. But
No, you're absolutely correct. But with the pitch deck, besides the ask, your summary has to be, it should be precise or concise and like straight to the point. I've had 50 pages, and I'm just telling you from someone that we all deal with bankers day in and day out. They are not reading that whole pitch deck. So the pitch decks look beautiful, and the teams, and it just working with underwriting, you need your sources and uses, but you need your summary, your ask, details, and to the point, like 2 paragraphs at max. Hey, you ain't be just for your summary, but that's just for that you can go.
completely agree. So those are probably the top 2 things, because again, if somebody's looking at 100 of these a day, they need to very, very quickly know, like, what are you all about, and what are you looking for, and what are you going to do with it? Like, that's the very quick. But then they also, if that does the third thing is, what's your differentiator? What's your niche? What's your differentiator? Like, why you? What do you have that's unique and different? Why is this valuable? Like that strategy, that plan, that again, the highlights essentially. They don't necessarily need to know the really deep roots of your IP. They just need to know confidently that you have something special and why, right? So if you can communicate that simply, clearly, versus through 50 slides that they're not going to look through, that's part of it. And then there was a second part to that question.
It was, but I want to add, there's a cheat code and everybody should use that costs you $20 a month. Okay? This is the cheat code. Get a Dropbox account. Put the document on DocSend. Pay for a premium account with DocSend. Require an email account to be entered into it to view your document. DocSend will track how much time they spent on the document and what page they actually went to in your documents. Now, funny thing is, we did that for our pitch decks for sponsorship. Average person spent no more than 2 minutes and 52 seconds looking at our deck. My designer spent 2 days to put that together. I'm not doing that shit again. That was the more. Number 2, the people that spent money with us spent the average of 1 minute and 30 seconds on the deck. Wow. They are reading this. Yeah. It may hurt your mark. Some of y'all probably have some of the most beautiful pitch decks that look like a video that should have been a part of the Odyssey. But I'm telling you right now, just like the Odyssey, your reality is fictional. They aren't reading all that shit. If you can't get them within the first 4 pages, you're out.
Yeah.
So how you're going to get on with it?
I would say, honestly, just the second slide. Because honestly, was the ever do one? Just me. I will look at, obviously, usually have a cover slide. That's slide 1. Slide 2, hopefully, is pretty much your executive summary. I'll look at slide 2. If it's not clear and I don't see very quickly what's going on, I probably won't even continue, to be honest. That's just me personally. And then the next slide I look at is the last slide, because that's usually when the ask is you always wait till the very end to what's the ask. So I literally will go to the last slide. I look at the second slide and the last slide. I've shifted down. I said, no, but
What he asked, also, hey, it's 3 and the last page with my contact information.
Yeah.
As in, you want to talk to me? This is how much money I need to talk. Right? So as they say, you don't wear a Rolex to tell the time. You wear a Rolex to let people know how valuable your time is. So you got to think about it with them. Don't waste their time. They probably aren't going to read too much about you, but you'll see that. That's why you on DocSend, because you'll see the patterns of behavior. Because you'll be like, oh, a lot of people are spending a lot of time on page 3, but they're actually getting stuff on page 15. So whatever I said at 15, you have to go up to page 4.
And again, the simple version, it's just like dating. It's just like dating, where it's just if you have an initial good hook, they're going to continue the conversation and so on and so forth. So anyway, so that's all. That's
To be single forever if it's like dating.
A really good, so on a prelim, right, and I'm very versed with the term sheets, your indicative term sheets, which is hey, it's like LOI, hey, I'm interested in this project. And I'll tell you right now, it's based on financials, whether it's pro forma, PFS, executive summary, bios, bios are they're looking at those over. And the pitch deck, they're like, it's needed. You know, we're going to need more detail during underwriting and when we break it all down. But at the very, very beginning, executive summaries, summary, of course, executive summary, financials, whether they're, again, whether you have a pro forma, they like to see audited financials are also very important. Audited financials, it's always a preference. If they're going to choose financials, and you want to stand out in a crowd of 50 submissions, audited financials will definitely pique interest in a lot of these private investors.
And I would just suppose it. I'm sorry, boy, finish that. No, please finish it off.
It's very important. So your audited financials, pro forma, executive summary, bios, that gets you through the door. That is what is grasping these and getting your term sheets out in a timely fashion. I've had beautiful pitch decks. I've had executive summaries. I've had like beautiful details. And then they always come back and Priscilla, where's the financials? I'm like, oh, they have PFS. They're like, on bank account, just like the nice lady over there, young lady stated. They're like, but what's going on here? Where's the financials at? Can I get a pro forma at least? I'm like, yeah, I'll get back to you.
I think if I want to stick with Raina's analogy, since you're a married man, and I respect that, you haven't dated in a while, praise your soul. How about that? It's rough out there, bro. But I would say this: pitch to date, don't pitch the proposal. Does that make sense? Yeah. Because it's too much too soon. They're not going to take the all. It's like if you meet a girl and you're like, "We'll spend the rest of my life with you. You're everything I'm looking for." Bro, I just wanted to try to get a free meal by it. That's how I felt by D. But I'm just telling you guys, pull it back a little bit. But if you heard those big four, that's what you want. Out of respect to their time, they're going to be available. But like I said, this is strategically a part of Tampa Bay Taxi. This is a resource. This is a part of the team, so they're accessible. I will tell you, out of anybody I met in the financial industry, they're some of the most kind and welcoming people. They will answer your questions. Just also think of yourself. Be respectful of their time. Doesn't mean it's just a bad question. Just be respectful of everybody's time. So we want to thank you all for coming out before you clap.